Welcome everybody to the divorce and home lending training today. It's one of my favorites. I think it's a great missing hole, and I think Jolene does a great job. Okay, I'm Cindy Bishop with Cindy Bishop Worldwide, and I'm going to introduce our speaker today. The topic is so crucial for all of us. Our instructor is very skilled in providing this, and I don't know of anybody else that can provide divorce training like this. I think it's excellent. Our speaker, Jolene Moore, is a top producing lender. Her knowledge of the market and real estate industry, as well as her real life usage of many of these principles, make her one of the best authorities on this topic. And I hope that it really opens up leads for you guys, because this is just an awesome opportunity of knowledge. Jolene has an abundance of skill and expertise and a keen ability in helping real estate agents grow. She is not only a top producing lender nationwide, she is also a branch manager and senior loan home consultant with Cross Country Mortgage. Jolene is also well respected and sought after trainer with us, Cindy Bishop Worldwide. Take it away, Jolene.
Thank you so much, Cindy. Thank you all for being here in August, last month of the summer. So appreciate you guys taking the time out of your summer to learn a little bit about divorce. So I started teaching this a few years ago, and I've kind of just refined it a little bit. So I'm going to touch on kind of relative to the lending, what impacts divorce has regarding home finance. I'll touch a little bit on relative to you all with listings and the property settlement agreement and what to keep in mind. And then also highlight some points that the title company, I've taught this with another agent, I've taught this with a title company. So I'll kind of add in their perspective as well, so that you all can benefit from the different points that they've shared as well. So like Cindy said, I have my chat up. So if you guys have questions, please put it there. And then also I'm happy for you to unmute yourself. I love interaction. I love those of you that have your camera on. Thank you. Nice to actually look at people as opposed to a black screen. So thank you for that. And I actually did just teach this part of it to the Virginia, the Fairfax Bar Association as well, to try and help them understand the guidelines as well and what their possibilities are for their clients. So look forward to this. So some resources that you can keep in mind for your clients. So there is a group, a group and a class that's called a Second Saturday Workshop. And this is something I volunteered with prior to COVID. And basically what it is it's usually a law firm that puts this together. It's the second Saturday of the month. It's geared towards women, and it has different professions there. So it's usually a lender, a realtor, a attorney, a financial advisor, and a counselor. I think when I did it, the women paid like $25 to come to the class. So it's very inexpensive, but it allows them to come and ask questions to all of those different professionals. Obviously, most of them were probably the attorney related, but they had, questions for all of us. So it's a great resource for people who are, thinking about or contemplating the next steps and what that would look like for them if they were to go through a divorce. So keep that in mind. Obviously, great people to talk to in this sector is financial advisors, divorce attorneys, counselors, and lenders. If you don't already have someone, in these realms, I strongly recommend creating relationships and contacts, trying to refer to them as well in those 4 areas. I have a financial advisor, they've referred to me, I've referred to them. I have divorce attorneys, a couple of them who refer to me, and vice versa. I just closed a transaction yesterday from a divorce attorney that I work with. Counselors, and then obviously there's lenders like ourselves, as well as other agents. So definitely start to create those connections. So for me, when I have a client that reaches out to me and says that they're going through a divorce, one of the first questions I'm going to ask them is do they have a property settlement agreement? So as I'm sure you all know, in Virginia, there is no legal separation, right? So it's not, you're separated, you have to be separated if you have children for at least a year. If you don't, it's 6 months in Virginia, but there's no formal legal separation. But most parties, good majority of parties do put together a property settlement agreement prior to the divorce being finalized. So in that property settlement agreement, it's going to help us understand what income that they may be receiving, or what liabilities they may have going out. If it's them that are, you're going to be paying child support or alimony or any other type of financial obligations? If so, for how long? If there's a marital home, what's going to happen to the marital home? Majority of them will outline, either that they have to sell it by a certain time, or the other party is going to be taking over the debt and they owe a certain amount to the other party. So it really helps us outline and know what the financial obligations are going to be for the client that we're talking to. And then also we'll talk about other debt obligations beyond just the marital home. So there's obviously, many couples buy houses together, cars together, have credit cards, joint, things like that. So we're going to work through and figure out if there's other debt obligations that have been outlined in that separation agreement. Now, if the divorce decree has been finalized, we're going to get a copy of that as well, because now it's become court ordered, with that divorce decree being finalized. One thing to keep in mind that we do look for, so there's a couple things. So one, if the marital home and that, the other spouse is going to be taking over the marital home, and it outlines in that separation agreement that that other party is going to now be responsible for that monthly debt and for the mortgage, even though our borrower may still be on the loan, if it states it in the separation agreement that the other party is now responsible, we don't have to include that debt in our debt to income ratios. So the client I just mentioned to you that closed yesterday, she was going through a divorce. She had a property settlement agreement. That agreement stated that the ex was going to be the one that was responsible for the mortgage. And because it outlined it specifically in that agreement, we did not have to count that payment against her for qualifying. Now, if they don't have an agreement, but let's say they've been separated for a while, but they don't have the agreement finalized, but the other party has been making the payment for past 12 months, that's another way that we can be able to not have to count the debt against our borrower. So if the other party has been making the mortgage payment for the past 12 months from their own account, so it can't be a joint account, but it's from their own separate account, and we can get documentation showing that they have made those 12 months payments, then that's another way for us to not have to count the debt against our borrower when we're looking at qualifying them. Now that also applies to like car loans, or any other debt. So if there's any debts that are outlined on that separation agreement that states the other party is now legally responsible, again, we can exclude those payments from the qualifying for our borrower. Anyone have any questions on that? All right, so child support. So child support and alimony, of course, can be used as qualifying income. I'm sure most of you know at this point, but just in case, in order for us to use child support and alimony as income, they have to have been receiving it for at least 6 months. So unfortunately, if you have a client that is just starting the process, or they just figured out exactly what they're going to be receiving with child support or alimony, but they haven't been receiving it for at least 6 months, then we're not able to use that as income for qualifying. So we have to document that they've been receiving it for 6 months, that it has been consistent as well. So there can be challenges if they've received it for 5 months, but 1 month was skipped and then another month occurred. If we have a long history of them receiving that payment, and that was a rarity that 1 month was missed, we may be able to get away with it. But the majority of the time, the underwriters want to see that there's been consistent payment for the past 6 months. And that those payments are reflective based on the agreement that we have. So if the agreement states that they need to, that they have to pay $1,200 a month, we want to see $1,200 a month in receipt of our borrower. Now, if there is agreements where, they have to split expenses for the child, and that there were additional expenses, and that's why 1 month it might have been higher and the other month it was lower. Again, if we can explain that, then majority of the time that will be accepted. But we want to see consistent payment. The other thing that's important is that they have to be receiving it for at least 3 years from the day we go to closing. So if we're closing, next month in September, we have to document that the borrower is going to be continuing to receive that child support or alimony for the next 3 years. Now, one thing that is helpful in this regard is, as you guys know, most child support ends when a child turns 18 or when they finish high school. So there have been many situations where I've had a client whose child's 16, which would make us believe that the child support's going to end in 2 years, but is a freshman in high school. So we know they have 3 more years left of high school. We can get a copy of their transcript, their school transcript, to show that they are a freshman, so that we know that they're going to be continuing to receive it for the next 3 years, so that we could still then use that income. Now, if let's say they have 3 children and 1 child's going to be aging out. So we have 2 that are going to continue to receive it for the 3 years. What normally we would do is take the amount that is indicated, if they're getting $1,000, we'll divide it by 3, and we'd be able to use 2/3 of that and exclude 1/3, because we know 1 child is going to be aging out of the child support. So those are some things to keep in mind, and things to kind of be aware of what we're doing on our end of how that's going to help. We try everything we can to use as much income as we can for all clients. So I've gotten creative. I've, figure out ways to help us, maximize it, like with the school transcripts, things like that. So we also do have to have something in writing. So there have been many clients of mine who have not had official separation agreements. So they've, either 1, it's amicable, so they haven't really had to outline too many things, or 2, they're still working through, some of the logistics of the agreement. But if we can get something in writing from both parties and signed by both parties that states that this is the amount that's due, from one party to the other, and this is, for how long it's going to be paid, then we can be able to use that income as well. Same thing with, child support and alimony. Now, something to keep in mind is if our borrower is the one that's actually making the payments, paying the child support or alimony, we have to count that in their debt to income ratios, even if there's only 1 month left. So it's something that we still have to qualify them for, and they don't have that 3-year continuance like they do to use it for income. But for debt, if there's, any time period left, then majority of the time we're going to have to count that against them. Now, we may be able to get away with it if it's only a couple months, less than 10 months, we may be able to exclude it, but it's going to probably be on a case-by-case basis. So something just to keep in mind. The other thing I will tell you is I've had clients that don't tell me at the beginning of the process that they're doing one or the other, right? They're either paying it or receiving it. I would say that it's in it's come up a couple different times in different situations we've had where clients have excluded things thinking we're not going to find out. I will tell you, in our day and age, and in the mortgage industry and all the different reports we have the ability to run now, we're going to find out. There's not many things that people can hide from us at this point in time, because there's so many different data points that we have the ability to run to find out. So you always want to encourage the clients to tell us everything that their situation entails, so that we can make sure that we're helping them the best at the very beginning, and not creating challenges down the road when we get copies of bank statements and see that there's a payment going out to another party, and we have to verify what that is, and now it's child support or alimony. So it's just something that it's really important for everyone to be very upfront, and you disclose all information to us at the very beginning, so that we can make sure we're helping them the best that we can. All right, anyone have any questions on child support and alimony?
Jolene, I have a question.
Yes.
So if one of the parents, they're paying child support or alimony, that goes against their DTI, like if they were going to buy a home or.
Yep. Yeah, it is considered debt in our eyes. So if they're paying alimony or child support, we do have to count that payment against them in their debt to income ratios.
But do lenders ask that upfront? Because I have not seen lenders ask that.
No, they do. And we're going to, like I said, we're going to find out, because if we see, it's going to be we're going to get copies of the bank statements. We're going to see the payment coming out. And the thing is when underwriters look at bank statements now, they're looking at everything. They're not just looking at large deposits. They're looking at payments that are reoccurring, or they see payments going out. Then we have to verify whether or not that payment, what that payment's for, and document it. So, there's so many things that come out now with bank statements that if if they try not to, to get away with not telling us, there's more than likely there's going to be ways that we're going to end up seeing it. So it's highly, I would not try to not disclose that information.
Understood. Thank you.
Yep. All right. Anyone have any other questions? All right. Very good. So something to keep in mind, this has kind of changed over the years. I think in 2019 is when it changed again, but child support and alimony aren't taxable and they're not tax deductible. So that's the one thing, is it's not going to show up on the tax return. So that is definitely not a document that we're going to see it reflected. But like I said, we'll be seeing it in bank statements and such. All right, marital home. The one thing to keep in mind is when you have a client that is looking, that you have one client that's one spouse that's going to buy out the other spouse. And it's spelled out in the settlement agreement that we were just talking about, that, one spouse is now going to take over that debt and they owe the other party a certain amount of dollars or percentage based on that. If that is all spelled out in the agreement, then we have the ability to do a rate and term refinance. And why that's important is because when you look at refinancing, there's two different ways to refinance in the mortgage industry. So it's either a rate and term, which means you're just paying off the current loan, you're allowed to roll in closing costs. The loan to value is much more flexible. You can go up, on a conventional loan up to 95% loan to value. And the rates are going to be the best that, the market allows. Whereas if you're doing what's called a cash out refinance, it means that normally the loan to value on a cash out refinance is on a conventional loan is going to be limited to 80%. So it's much more limited on the loan to value. And the interest rate is higher because they look at it as a bigger risk because you're taking equity out of your home. So when it's due to us buying out another spouse on the loan, to take that spouse out off due to a divorce, Fannie Mae and Freddie Mac allow you to do that still as a rate and term. So even though we're taking equity out of the home and there's going to be money coming out of that property to go to the other party, they still allow us to do that as a rate and term. So like I said, that's important because it's going to give you the best rate and it's going to allow them more flexibility on the loan to value. So if we have it spelled out that states that the other party is taking over, this other party needs to come off the loan and they're going to have to pay that spouse $50,000 in order to do that, then that's what allows us to do this as a rate and term. Now, the important thing to note is that it will be paid on the CD to the other spouse. So if they says that they now have to, they have to refinance, take this other spouse off, pay them $50,000, then that $50,000 would be reflected on the CD to show that we're paying that party the $50,000 that's due to them based on the agreement. So I had a situation where we were doing a refinance and the other party owed their ex, like, let's say $50,000. She only wanted to take out 35 from her house, right? So we did a refinance for her to net $35,000 to be paid to the other spouse. But because we were doing it as a rate and term refinance and using that, caveat that Fannie and Freddie allow, we had to pay off that spouse in full. So we couldn't just pay the $35,000 that we got out of the house. We had to pay the $50,000 that was due to that ex-spouse in order to be able to buy them out of the house and now not have any ownership to that home. So that borrower had to bring $15,000 of their own money plus the $35,000 that we're getting from the house to pay in full to the other spouse the $50,000. So there's little things and we have to kind of be aware of and help, navigate them through, but something to keep in mind. One thing that I always recommend to clients when I'm looking at doing this for them is when we look at, how much does that spouse due, is calculating the cost of selling the house when they're buying out another home. Because obviously the only other way that this spouse would have gotten the money from the home is if they had sold. And if they sold, there's real estate commission, there's closing costs involved. So what does that look like so that they take that into consideration when they're calculating what they are, what the other parties do. This is again where we talked about, if we need to, worry about qualifying, we can, count those, get documentation of the 12-month payment history. The other thing that comes up a lot is capital gains. and this is something that's important to think about when a client is thinking about what do. They want to keep their current home, and buy out the other spouse, or do they want to sell? And if they have quite a bit of equity, and they've made a lot of money off the home, sometimes it may be better for them to sell when they're still married, because the capital gains exemption is now $500,000. Whereas if they are single, the capital gains exemption is $250,000. So if they think, oh, I'm just going to keep the home for a year, I'm going to buy out my spouse, keep the home for a year, and then I'm going to look at selling, and they might now exceed that capital gains exemption of $250,000. That's something that they want to think through and work through to make sure what makes the best financial sense for them. But the other thing to keep in mind is the client, that has now been bought out, and I have this come up, like I had a client that's looking at selling a home, not related to a divorce, but they're selling their home and they're going to make, let's say 150,000. They're like, oh, well, I have to reinvest that into real estate within a year. And that's where I think there's a lot of misconceptions of how that works for clients. So it's something on our end that we need to, make sure we're educating them on, that, if they don't exceed the capital gains exemption, then they don't have to invest in the real estate to be able to, not be taxed at the end of the year. So those are things, obviously, they want to work with a CPA. I am not a CPA, but these are questions I've asked my CPA so that I can have a better understanding how this works for everybody. But it's definitely something that they want to think about and keep in mind. The other thing to keep in mind too is that if, let's say that there's, both parties have been living in the home, but only one was on the title and one was on the loan, and the other party didn't have ownership, even though they've been living in the home and, technically they were married to the party that owned it, they would still be considered first-time home buyers because they weren't on the title and they weren't on the loan. So they would have the ability to benefit from first-time home buyer programs that are out there. Anyone have any questions on the marital home? Well, hopefully I'm just doing such a thorough job, or you guys already had the knowledge, but would love to hear it back and from you at some point. And also any feedback too, any information that you guys have, you want to pipe in, and anything that you might know or learn of, that would be always love to hear from you guys as well. Something else to keep in mind, and this is something I had asked my CPA, is, the capital gains exemption is when you've owned the home for at least 2 years. And then, like I said, singles 250, married is 500. So I did ask him, if you have owned the home for less than 2 years and you're going to sell it, do you get any type of exemption relative to the capital gains? So basically what he explained to me is, what you count the months that you were in the residence and divide it by 24. And then you multiply that ratio by 500,000, and then that would tell you the dollar amount that you would be exempt from regarding the capital gains, based on how long you lived in the home, if you haven't hit the 24 months. Anyone have any questions, or did you guys all know that? Did everyone know that? Because that was something I didn't know for sure, or how to calculate that until talking to the CPA.
No, I didn't know that. I just assumed it was the 2 years and you would completely be exempt. I had no idea that you could count the months that you lived there. That's really helpful.
Yeah, good. Yeah, because that was something I wasn't aware of either until like a year or two ago. And I've been in this industry for 20 years. I'm like, how did I not know that? But yeah, that's what my CPA explained to me. So that will, help you guys if you know clients that are looking to sell and it hasn't been full 2 years, that they may not, have to pay capital gains depending on what their profit looks like. Okay, so when listing the marital home, so this is, again, like, these are things that we talked about, like when I've taught this to attorneys, and also one of the agents that I had taught this class with was a former family law attorney herself. So she kind of helped me understand things that, are in the agreement that you want to either help educate the client on when like they're coming to you very early in the process and they haven't outlined the separation agreement yet. These are some things that you can recommend to them that they put into the agreement, so that everyone already addresses that and has a clear understanding of what these things will look like to help your guys' job be easier. Obviously, if they've already have the separation agreement when you're talking to the client, these are things that you want to look at in the agreement if they have been outlined, so you know what those requirements are going to be for you as you list the home. So mandatory price adjustments, obviously, we have a very strong market right now. It's not always, as we know, like this right now, and we anticipate for, some time to come. But depending on what they price, and what agreement they can come to will help you understand and know if there needs to be any type of price adjustments. Because if it's a couple, who wants to list high and higher than what you would recommend, then obviously you might have to end up doing some price adjustments depending on the market and how that goes, and also the condition of the home. So figuring out, mandatory price adjustments, what you're going to list it for, but then also what does that timing look like of when you might make any price adjustments, and if so, by what percentage or what dollar amount. Accepting offers, again, if what's reasonable, considered reasonable for them, and accepting offers, if the sales price, if it's within, $5,000-$10,000 of the list price, is that acceptable, or is it only list price, or, anything like that. So either, again, it can be a dollar amount or a percentage of the list price, so that then this is an these are all things that you guys may already do, but I think it's just helpful to think about that you have these conversations, especially in this situation when there can be more tension, and may not be total amicably separating, that you have these conversations with them up front rather than during the process of the listing. And then repairs and credits, are they going to how are the costs of any repairs going to be handled? Are they going to repair ahead of time before they list and make any updates, or are they saying no, it's as is, we're not doing any? And then once they're under contract, if there is a home inspection, what type of repairs are they going to do? Or are they going to want to just give some type of credit, for the home inspection, things like that. So kind of working through all of those things. And like I said, if you guys have hitting them in the very beginning and they don't have the agreement, great things to talk to them about and help educate them on. If they have an agreement, ask to see the agreement relative to the marital home, so you can see if there's anything that's been outlined in the agreement relative to these. The other thing that I've always talked about in any of these classes that I've in the second Saturday workshop that I did is suggesting that they do a CMA rather than trying to do an appraisal. Obviously, you guys are, very well versed in the market, the communities, you can run the comps, you can see what you would suggest that the house be listed for to help them determine the value, which can either be to list the home, or potentially if one spouse is going to buy out the other and you're going to help the other one buy a different home. So, when an appraisal is done, as I'm sure you all know, we aren't able to use it if we don't do it ourselves. So unfortunately, lenders are not able to use appraisals that are done outside of the lending process. So they're paying additional cost that they may not be, make financial sense to do so, rather than working with you all to get a CMA and get the information that way. So that's something that I always, mention to clients. Now, I did have a situation where it was a very amicable separation, and one party was buying out the other, and then I was helping the party that was being bought out go and buy another home. I did the refinance to buy out the party, and I did the purchase for the other. So on the refinance, they had me do the appraisal as part of the refinance, and whatever that value was is what they used. And then they drew up an agreement that stated, based on that value, that here's what the other party is going to be paid. And I was able to then do that as a rate and term refinance, and then also document it for the borrower who's going and buying the other home, to be able to document where her money was coming for the down payment. So obviously, if that was a very amicable situation, I had worked with the both parties prior to and helped them in multiple different transactions, so they both had trust into me. But it's something to think about, that they want to kind of work cohesively together as much as possible if they can, to work together when one party's buying out the other. So like I had the one that closed yesterday, the agreement stated that the husband was going to buy out the wife, and he was going to pay her this amount of money. And he paid her this amount of money, but it wasn't through the refinance process because he was trying to help her be able to purchase a home faster than the refinance was going to allow that to happen. So we had to just have a letter written and signed by both parties stating that they did something different than what the agreement stated, and that they actually, he paid her the money in a different manner, but that was, kind of what they both agreed to. So, it was simple. It didn't follow the agreement, but the underwriter just wanted both parties to sign saying, here's what we did instead. And we were able to, again, still not count that debt against her and use the money that he gave her towards the down payment. Anyone have any questions on the listing of the marital home? Have you all had situations where you've, asked for the listing agreement in the situation, and have any of these items been outlined in any of those agreements?
Yes, I've ran into this situation many times.
Awesome. And did those agreements like outline like the adjustments and accepting offers and things like that?
Yeah, the big problem I've run into over the years is husband and wife disagree on what the pricing should be.
Mm-hmm.
And I always go to the appraisal just because it's third party and, no one is depending on me specifically. So they're able to agree. And then I've always just said, okay, if we can't agree on the price, let's go with the appraisal. And then after, we agree on so many days, whether it's 10 days, 20 days, 30 days, to go ahead and start reducing the price and go ahead and get that in writing in the listing agreement. And that really helps because sometimes these things can be really emotional and
Mm-hmm.
charged.
Mm-hmm.
So if you have things written out and ahead of time, it's much easier to deal with it along the way.
Very good. Yeah, totally agree.
And also
I
really agree on repairs, because that always comes up where there's going to be either credit has to happen or repairs, and then who pays for it. So if you go ahead and deal with that ahead of time, wow, that's a lot of help.
Mm-hmm. Yeah, very good. Yeah, and I totally understand relative to the appraisal too, and I'm sure you've done this as well. And what I would just say, and you obviously probably have a relationship with an appraiser who does this, but if anyone else decides to go that route, what I would just recommend is when the appraiser does it, is just ask them to do it as if they were doing it for a lender, because then they're going to follow our guidelines, like that it has to be within, certain mile radius of the home, that the comps would have had to have settled within a certain time period and things like that. So that it should be very close to either what the appraiser would potentially come in at, but also if they were to go and refinance, it'd be, similar to that as well.
I have a question.
Yeah.
So in that respect, should we not tell the appraiser that this is for divorce? Because sometimes they ask, like, oh, yeah, no.
Yeah, no, I don't think that matters. I would just say again,
good.
that, just mentioning to them to follow the typical guidelines as if it was being done for a lender. And I think that would just help it be, kind of in line with what you'll probably see when you list it, or if they were to refinance.
Gotcha. Thank you.
I have one more question.
Yeah.
And I think you touched on this a little bit, but I just want to clarify what you said. When one party's buying out the other party, and the one party is going to be depending on that money that's coming out of the equity of the home, obviously, you go from the sales price that you could sort of give them information on how much money, but beyond that, you also need to factor in commissions, settlements, and all that. And so what is the sort of the standard formula that you use to quantify that? Do you just use like a 6% commission and then look at what a standard settlement would cost, closing costs? I mean, how do you sort of figure that to sort of give that party who is going to be using this money to buy something else? How do you quantify?
Yeah, I would say 5 to 6% commission, whatever you guys see on average is occurring. And then you're like closing costs, on a sale, I think are, it's nominal, but I would say probably 5, depends on the sales price, obviously, but 0.5% to 1% in closing costs. I would say probably more of 0.5%. And then calculate that, whatever the sales price might be minus those closing costs and commission. That's what I would say that they would potentially net if they were to sell. minus obviously what they owe. And then that would be the amount that they would then split.
Okay, thank you.
Mhm. All right, awesome. Well, thank you guys for the questions. Okay, so something else, unfortunately, and I do think this has improved over the years. It's from when I, started in midway through my career to now, but it does unfortunately still have a big impact. Obviously, you all know that credit is a very important piece of the lending, and it's something that impacts, the interest rate, but obviously the programs that they are qualifying for, the cost of the mortgage insurance, so many different factors. So one thing, that I've always recommended and talked to clients about is one, trying to separate their liabilities as soon as they can. So like we mentioned, if they have a joint car, a joint credit card, the mortgage, obviously, if they're going through an attorney, the attorney is going to outline all of this and, make sure everything's separated. But not everyone uses attorneys. Some try to do it on their own. Some trying to use mediation, things like that, which obviously still attorneys, but it's just maybe a little different process and it may take a little while to get to there. So if they're trying to, work on it themselves or, nonetheless, is that make sure that they, try to refinance the car out of one party to the other, that they remove themselves from the credit cards if they can. I know a lot of credit cards now is one party is the primary card holder, then the other is a authorized user. So remove yourself if you're an authorized user. Remove yourself from anything that you can, separate your bank accounts, things like that. But then the other thing that's important is making sure that the payments are paid on time. So unfortunately, I got a client that I was talking to yesterday. Her credit score is 637. She has 3 late payments in this year, this year on three different credit cards, not related to divorce. But what I explained to her was by having 3 late payments on 3 different credit cards this year, if those were gone, she'd have a 760 credit score instead of a 637 credit score. So late payments have such a big impact on the credit score. So it's just making sure that they know that pride, anger, like you were just saying, Leah, that, emotions are very strong and that unfortunately can really drive people's, actions, is trying to help them understand what the implications are going to be if they choose not to make a payment on the mortgage, on a credit card, on a car, any of those types of things. Yes, they might be hurting the other party's credit, but they're hurting their own. And as you guys know, with rentals, if they have to look and go and rent anything, the credit is going to have an impact there as well. So we really want to just try and help them educate all parties that they just want to make sure that they're making their payments on time and that they don't let the anger and the pride get in their way, because, credit also takes time for it to improve. So, it's not going to be overnight where all of a sudden she's going to go from 637 up to 760. It's going to take, a year to 2 years before we start to see that credit score improve and get higher. And it can take several years to get up to the 760 mark. So anything that you can do to help impart, education on your clients relative to credit, I think could be very valuable so that we can help them in the long term as well as the near future. So something that we always want to keep in mind. All right, so funds for down payment. Oh, anyone have any questions on credit before I move on? Okay, so funds for down payment. This is something else that comes up often. Obviously, like we just talked about, funds that they get as a payout from a marital home, current savings investment. Obviously, they want to make sure that they have authorization to use those funds when going through the divorce or, separation. Almost every loan we do now allows for gifts, and majority of the loans allow for the gifts to be 100% of what's required for cash to close. If we're looking at like a jumbo loan, those are going to have required investments from the borrower. But otherwise, the majority of them are going to be allowed to be gifts and cover all of the down payment. We can use loans from 401ks. And, one of the benefits, obviously it's tax-free and penalty-free when you're borrowing for the purpose of buying a home. But the other benefit is we don't have to count that payment when we're looking at qualifying someone for the mortgage. So if they have a $300 payment for a $50,000 401k loan they're going to do, we don't have to count that $300 as a debt when we're looking at qualifying the borrower. Something that to keep in mind is for retirement loans, because this came up recently. I had a client knowing they had a lot of money in their account, thinking they could borrow a lot of money. And the IRS has a maximum allowed of $50,000. And most 401k providers are going to require that you only are allowed to borrow from what you have vested in the account. And it's usually up to 50% of what you have vested with a max of $50,000. So keep that in mind. The thing that I just recently encountered with a client, that they had an IRA that was a previous 401k, but had rolled it over into an IRA. And the IRA was $250,000. We needed $200,000 for a down payment for their house because they hadn't sold their current house yet. They were able to take the money from that IRA without being retirement age. And as long as they paid that back within 60 days, there was not going to be a tax or penalty associated with that withdrawal. So even though it was a large amount, it was an IRA, different than the 401k. We talked to a financial advisor. You can only do it one time. So it's not something you want to just go and do, but have this conversation. And if clients mention it, there's a lot of ways that we try to be creative and find ways to help clients. So that's something that we just recently did. And that was one of the first times I had done that in my 20 years, but it worked out very well because their house actually ended up settling the next day and we're able to pay it back immediately. So lots of ways for us to come up with down payments. Anyone have any questions on down payments? All right. So title. This is one of the title companies that I work with. Some things that he just kind of gave us pointers and to keep in mind is to treat each seller as an entity, separate entity. You know, I think a lot of times, and I know I do this myself, when I have a couple, you know, that I'm working with on purchasing a home, you know, I might talk to one the majority of the time and not really talk to the other. But it's really important in this situation is treating them each almost as individuals, even though it's a joint transaction, because they may not be communicating with themselves and with each other. So we want to make sure that, you know, we're all communicating with each of them so that they're all aware of what's happening in the transaction. So we need to get separate contact information. You know, is it amicable? Can they sign together at closing, or do they need to be, you know, separated and be signing separately? And if, you know, we were kind of talking about this earlier, but if there are proceeds to be split, have it in, you know, an agreement prior to going to the settlement table of how those proceeds are going to be split. You know, he mentioned that he's had situations where that hadn't been done and it took, you know, sitting at a table all day before things were ironed out. So obviously that's not going to happen very often, I don't think, but it's just something to keep in mind. And then each seller signs an assignment of foreign fund at the time of closing to tell them exactly where, you know, how the money is going to be split and where the money is going to go. So they can't, if they can't sign that form, then the closing can't be finalized. Both sellers must sign, therefore they need to agree to the amounts. You know, they're not, the title company is not the attorneys or mediators, so it's something that they definitely need to work out prior to. And then like he's saying here, if they can't agree, then they can't disperse the funds. So that can hold up that process. So just making sure, you know, obviously if it's amicable and this has all been out and agreed upon, you guys have seen the settlement agreement, property settlement agreement, you know how that's supposed to be split. It's not something that probably even has to be necessarily addressed too much, but if not, then it's something you guys want to make sure you've touched on and are aware of. Anyone have any questions on this? Have anyone had any situations where you guys, you know, had it kind of what he was talking about, where it wasn't amicable and had a closing that was held up by some of this?
Yes, I have. I actually had a closing recently with a couple I was working with. They were in a very difficult divorce and they could not agree on the proceeds because there was a disagreement on how much each one put in for a down payment. And they weren't agreeing on a 50-50 split of the proceeds. But they were in a hurry to sell their house because they wanted to, you know, stop living together.
Yeah.
So that's what we had to do. We had to just had it sit in an escrow account for oh my gosh, I think it was probably 3 or 4 months before they could finally
Wow.
get their PSA settled. But it was important to them because they wanted to stop living together, and that was the only
Right.
way to do it, was to sell the house. So that's how it got handled.
Okay. Wow. So sat in escrow for that long. Well, I mean, obviously, I guess it's a way to for the neither party to feel like they were shorted or slighted until they had it agreed upon. Um, all right, very good. Anyone else have anything or any other questions? All right, well, that's all I have. Thank you, the Leah, and I don't have the other person's name on there to tell me who you were, but thank you for the questions and
They were great. Yep.
so I appreciate you all. Here's my
Oh.
contact.
Is there a quick room for one question?
Of course, yeah.
Yeah. So what if the couple gets a home inspection to figure out what repairs need to be done, but then they kind of like, they should not, like, how does that work with a listing agent? Like, they shouldn't be seeing that ahead of time unless they want to disclose everything. I don't know. What do you say to that?
You mean, well, regarding repairs that come up from a home inspection and not disclose it to you?
No. So let's say they have gone off and done a home inspection
Mm-hmm.
in order to figure out who needs to repair what. And then they hire an agent to list their house.
Mm-hmm.
I guess once if they give that inspection to the agent, then obviously, they have to disclose whatever's on there, correct?
That I believe so, but there might be somebody
Yeah.
else here on the call that can probably answer that better, because I don't know all the ins and outs of.
I mean, do you see that a
regarding
lot with people doing a home inspection beforehand, or when they're going through a divorce, or not really?
I've never had that happen, but
Okay.
But my advice to you would be to say, if they've got a home inspection and, people know what they need to get fixed in their house, they don't necessarily need a home inspection to do that. So I would say you guys get things taken care of, and I don't want to see the home inspection.
Yeah, I would say that's good. And because as it turns out, I'm sure there's going to be a lot of disagreement anyways, because they find so many things on those things. So it's just better to fix the obvious ones.
Well,
beforehand.
And I would say if they don't agree to fix it again, even if they don't tell you what it is, to outline, it's kind of like what we were talking about earlier, is outline what they're going to be willing to give as a credit, or what they will repair ahead of time.
That's right.
Kind of like what we were talking about with your the separation agreement.
Okay, thank you.
Best advice of the day today, though, is don't get a divorce.
Yeah, exactly. I know. I mean, it's not, in no way am I want this to happen to anybody, but I want us to all be educated so that we know if you do come across this. So in the chat, yes, we'll get you a copy. We'll send out a copy of the presentation. And yes, and Cindy, you did record the class as well, so it's available. But here's all my contact information. If you guys need anything, the best email to reach us is at team@jolenemoreteam.com. And then also love if you guys go and follow us on Jolene Moore Team. We do put out a lot of videos with lots of education and information. So always feel free to share any of that information with your clients, or take and steal it and go and record your own class. So, we'd love for you guys to use anything we give you, put out to spread it out to your sphere as well. So thanks again, and have a great rest of the day.
Thanks, everybody.
Okay, take care.
Bye.